Old baseball players, Russell Wilson, and depreciation expense. This is Ken Boyd with the Accounting Accidentally Substack channel. So I'm a St. Louis native, and this is a town that's very obsessed with Cardinal baseball, and why not? If you look at Wikipedia, the Cardinals have won 11 World Series championships, the most of any NL team, second only to the New York Yankees. They've won 19 National League pennants, third behind the Yankees and Los Angeles Dodgers all time. Another thing we're proud of, we drew 3.24 million fans last year, which is fourth in the major leagues for a city that's not big compared to some of the other big markets. So how did St. Louis perform so well over such a long period? Well, this post describes the benefits of signing older baseball players, and I'll give some examples: depreciation expense methods, and the critical decision to replace assets. So first, let's talk about signing older players. Over the years, the Cardinals have benefited from signing older players and getting great performance out of those players, even on a part-time basis. The question is why? Well, experience really counts in baseball. Veterans know about the pitchers they face. They've seen thousands of plays they can learn from. For example, do you swing at a 3-0 pitch or do you take it hoping that it's a ball? Depends on the pitcher, the score, and who's on base, if anyone. How fast are the players who are on base? Are they on second or third or only on first base? All those variables veterans know about. Here's a veteran player who helped the Cardinals win a World Series, Lance Berkman. The Cardinals signed him when he was 35. 2011 became a comeback year for Berkman. He was one of the team leaders in batting average, home runs, and RBI. He was named NL Comeback Player of the Year, which is an award to veterans. Finished seventh in MVP voting, and the Cardinals won the World Championship in 2011, beating the Rangers in 7 games. And for this year, the Cardinals assigned 2 older players. If you look at the roster, Lance Lynn, who's a former Cardinal, 1 year, $11 million deal. He's 36. Brandon Crawford, 37, an infielder, second base shortstop, 1 year, $2 million. But here's the key. What happens when older assets are no longer productive? And for that, just ask quarterback Russell Wilson. The Broncos paid Wilson a massive contract when they signed him, and now they've released him, and the Broncos will have to pay over $35 million this year and over $49 million next year in what the NFL calls dead money, money that can't be used to sign another player. Ouch. Which brings us to fixed assets. So what is an asset really? Well, it counts to define an asset as a resource used to generate revenue. So let's say you're a plumber. You buy a $30,000 truck, and you have fitted out with $10,000 in equipment, and you're going to provide plumbing services. And you ask yourself 2 questions. How long can I use the truck and equipment? And how much revenue can I produce with the truck and equipment before those assets are no longer useful? And the rate at which you use the asset determines depreciation expense. And this concept matches the annual expense of owning the truck with the revenue produced by using the truck. So using assets to make money is what we call depreciation expense. So let's first assume you use the $30,000 truck. You expect to drive the same number of miles each year. You've been in business about 15 years, and you know how many jobs you expect to work and about how many miles you expect to drive. So you decide to use the straight line method of depreciation. Since each year is about the same, you use the straight line method. So let's assume the truck has an 8-year life, no salvage value, which means there'll be no value at the end when the truck is used up. Your annual depreciation, assuming all that, is a $30,000 truck divided by an 8-year useful life, or $3,750 a year depreciation expense. Accelerated depreciation methods. So now let's change the example. Let's assume you plan on working a ton of hours the first few years, and then you're going to slow down in later years. Maybe you're near retirement age. So you'll produce more revenue in early years, driving more miles. You use an accelerated method of depreciation because, in essence, you're using up the truck faster. So several methods to choose from for accelerated depreciation, including the double declining balance, or DDB method. So here's how it works. When you use the straight line method, 8-year life, you're depreciating at a rate of 12.5% a year. The DDB method doubles that percentage in the year 1 to 25%, and that's how you figure the year 1 depreciation. So it's $30,000 truck cost times 25%, $7,500 year 1 depreciation expense. I won't calculate the later years, but For this discussion, assume that they decrease over time. The annual depreciation expense decreases each year. But here's a key point. The total depreciation over the life of the asset is the same regardless of the depreciation method that you choose. So if you post $7,500 depreciation expense in year one rather than $3,750, you're going to post a lot less in later years. But key thing, the total depreciation will be $30,000 using any depreciation method. And that's a check figure if you're calculating depreciation. The total is going to be the same regardless of the method. And finally, replacing assets. This is the tough part. When do you dispose of an asset? Many companies continue to use assets after they're fully depreciated. I'm driving a 2013 Honda Civic, fully depreciated if it was a business. Great car, I'll keep driving. They're old assets, but they keep producing, just like some older athletes keep producing. LeBron James is 40 or thereabouts and still one of the best players in the league. If the annual expense to maintain an old asset isn't excessive, in the case of my car, it's not, it may make financial sense to keep using the old asset and not replace it. So food for thought. You can find more great content at accountingaccidentally at substack.com. Thanks for watching.